greatest secret to reading the market is that there is no secret at all. This is the brutal truth. Most of you fail because you look for complexity. You chase advanced algorithms. You seek hidden equations and cryptographic codes where only simple, brutal repetition exists. You want to believe Wall Street is a battle of mathematical geniuses, locked in a contest of superior intellect. It is not. In reality, the market is a kindergarten. It is a playground of repeating fears and repetitive greed. I made my fortune, my millions, not by solving puzzles engineered by Harvard men, but by recognizing that human nature never changes. Not yesterday, not today, not ever. The pattern is always visible. The design is laid out for all to see. If you cannot see it, the failure is yours alone. You are looking at your screen. Yes, you are staring at the quotations. But you are blind to the tape. You must accept this reality now before we go further. The market is psychological before it is economical. The price is merely the visible footprint of human emotion. When you understand how emotion repeats, you unlock the mind of the market. You begin to see the inevitable design. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The costly lessons on timing and pattern recognition that defined Jesse Livermore's career were invariably learned through heavy market penalties, paid directly out of his capital. Fortunately, we have access to the ultimate training ground, the wisdom meticulously recorded by Edwin Lefebvre in 1923's Reminiscences of a Stock Operator. Reading this seminal work allows you to internalize the emotional and technical crucible of Larry Livingston's development without risking $1 of your own funds. However, to translate this foundational wisdom, the necessary prerequisites for navigating today's electronic environment, the Max Davidson edition is critical. His expert annotations bridge the historical gap, making the techniques of the original operator immediately actionable for the modern trader. A link to this essential edition is provided in the description below. We begin with the fundamental law, the eternal repetition principle. The market is not moved by news in the short term. It is not fundamentally driven by economics in the immediate moment. These things are mere window dressing. They are excuses deployed after the move has already begun. The market is moved by the collective action of men. It is moved by the crowd. Since men are eternally driven by the twin engines of hope and fear, the patterns they create on the price chart, the distribution phases, the accumulation cycles, the breakouts, the shakeouts, must and always will repeat. It is a law of nature, as reliable as the tide. Pattern recognition is not some arcane study of geometry. It is simply the study of predictable crowd psychology played out on the price chart. When the price moves up, men who bought too late feel hope. Men who sold too early feel fear. The tension between these forces creates the structure. You are watching a human drama unfold in numbers. You must stop trying to memorize the news headlines and start memorizing the emotional reactions to them. I learned this first in the bucket shops. The ticker tape never lies. It tells you exactly what men are doing, not what they are saying they will do. A pattern is history trying to replicate itself. Why? Because the same set of circumstances will inspire the same set of reactions from the average, poorly disciplined man. He will be greedy when he should be patient. He will panic when he should be resolute. Your job as a professional is to step outside that crowd and watch them perform their routine. The play is the same every time. The successful trader is a detached observer of these repeating cycles of hysteria. He knows the script. He knows the emotional peaks and valleys that cause the price to form certain shapes. Study the past. Study the charts of the greatest bull runs and the most devastating panics. You will find the footprints are identical. The names of the stocks change. The year changes. The pattern of human folly does not. If you can grasp that repetition is the foundation of all profitable speculation, you have already moved ahead of 90% of the men trading in the pit. They are chasing novelty. You are recognizing permanence. The patterns manifest themselves most clearly in the two core phases of market movement. The market only moves in two true patterns: preparing for a rise, which we call accumulation, or preparing for a fall, which we call distribution. All other movements are noise. They are minor corrections, fleeting spikes, or temporary reactions to trivial headlines. They are distractions meant to draw in the novice who craves action. The serious money, the smart money, the pool operators, the truly large interests cannot buy or sell quickly. They deal in massive blocks. They must take their positions over a period of time, quietly, deliberately, without alerting the public to their intentions. This necessary stealth creates the accumulation and distribution patterns. Accumulation is the long period of dullness. The price movement is contained within a narrow, choppy range. It is boring. It is frustrating. It drives the impatient man out. But this dullness is the key sign. The smart money is silently taking a position. They are absorbing all the floating supply of the stock offered by frightened or impatient holders. How do you recognize accumulation? Look for the price to refuse to drop despite bad news. When a market is weak, bad news sends it collapsing. But when a market is under silent accumulation, the price dips on bad reports only to spring back up to the middle of the range, seemingly effortlessly. The absorption is greater than the pressure. The hidden hand is catching all the shares. Conversely, distribution is the preparation for a fall. This happens at the top of a long movement. Here the price also enters a range, but now the large interests are unloading their vast holdings onto an optimistic public. They need enthusiasm to sell into. They need the crowd to believe the price will never stop rising. The pattern of distribution is recognized when the price cannot advance despite good news. The company releases excellent earnings. The press is positive, yet the price hits a high point and stalls. It moves sideways. It cannot gain altitude. Every time the price attempts to breach the high, new supply magically appears, pushing it back down. The distribution pattern is forming. The smart money is selling into the optimism. You must train your eye to see these two core patterns as distinct weather fronts. One signals planting season, the other, harvest. Do not confuse the two. If you trade based on the hope that a stock might be accumulating, you are speculating foolishly. A pattern means nothing without an objective point of confirmation. This brings us to the pivot point confirmation. My pivot points are not merely arbitrary resistance or support lines. They are critical price levels that, once breached with conviction, confirm that the established pattern is now viable. They are the execution signal. A price may bounce around in an accumulation range for weeks. This is the preparation. The pivot point is the price level, the high watermark, that when broken signifies that the accumulation is complete and the markup phase has begun. The pivot point is the door opening. You do not step through the door until it is fully open. Waiting for the pivot point prevents you from trading anticipation. You are trading based on what you think might happen. This is the vice of the amateur. Waiting for the pivot point forces you to trade confirmation. You are trading based on what the market has proven is happening. A pattern is a prediction. It suggests a future possibility based on historical behavior. A pivot point is an execution signal. It tells you the prediction is now validated by the current behavior of the smart money. The amateur sees the pattern forming and enters early, hoping to catch the first cent of the move. He risks being shaken out during the final stages of accumulation or distribution. The professional sees the pattern, marks the pivot point, and waits. Patience is the greatest capital. Once that price level is broken, not by a fleeting spike, but by a solid close, the market has given its permission. The signal is undeniable. If you jump the gun, you are guessing. If you wait for the pivot, you are executing. Do not confuse activity with professionalism. Let the market prove its trajectory before you risk a single dollar. A significant pattern requires time to form. This is the crucial element that most modern speculators ignore. Time element over price flashes. The market has a way of creating quick, sharp reversals or sudden spikes. These are often fleeting traps designed to draw in the impulsive trader. They look dramatic. They look like the start of something monumental. But they are usually false starts. The solid, reliable patterns, the ones that pay for your living, the ones that build great fortunes, are built brick by brick over days, weeks, or even months. They require sustained effort by large operators. You must measure the conviction of the pattern by the sustained effort behind the move, not the suddenness of the flash. A stock that climbs 50 points in one afternoon on rumor is highly suspect. A stock that consolidates carefully, absorbs all selling pressure, and slowly grinds up 10 points over 5 weeks, building a solid base, is ready for a sustained advance. The depth of the accumulation or distribution base dictates the height of the subsequent move. Think of it like a spring being compressed. A quick, shallow press will result in a small bounce. A long, sustained compression will result in a massive leap. Do not be seduced by the speed of a move. Be impressed by its duration. Impulsive moves are based on hysteria. Sustained patterns are based on calculated action by those who understand the true value of the commodity. When you see a stock forming a clear pattern, say accumulation, and then it attempts a breakout, but fails within a day or two, returning quickly to the range, it shows a lack of preparation. The time was insufficient. The base was weak. The time factor allows the smart money to complete their work. If they are not done accumulating, the advance will fail. If they are not done distributing, the decline will fail. Patience is not just waiting for the pivot point. It is respecting the time required for a proper pattern to mature. Never expect a massive move from a shallow base. When a pattern suggests a rally is coming, the market will almost always test the recent lows. This is the market's sincerity check. The test of weakness is indispensable. Before the markup phase can truly begin, the market must ensure all the weak holders, the nervous men, the margin traders, the amateurs who bought too high, have been shaken out. The smart money wants the path cleared. They do not want nervous hangers-on who will sell at the first sign of trouble, thereby forcing them to support the market unnecessarily. So, when the accumulation pattern appears complete, you often see a final sudden dip. The price drops sharply, sometimes breaching the recent lows, creating maximum fear. This is the test. The market is checking the supply. A true strong pattern will withstand this test. If the dip is sharp, but the volume is low, it shows the selling is merely the flushing out of the weak hands. More importantly, if the price returns quickly and effortlessly back to the critical level after the dip, the accumulation pattern is sincere. The dip failed to generate sustained follow-through selling. The supply is exhausted. The test was passed. If, however, the price collapses under the lightest pressure, if the dip generates high-volume selling and the price cannot recover the critical accumulation range, the pattern was false. The supply was not truly exhausted, and you must exit or refrain from entering. You must view this test with clinical detachment. It is a necessary friction. It is the market taking its temperature. If the market is genuinely strong, it will recover its feet immediately after being knocked down. If it is fundamentally weak, the knockdown will become a collapse. Never ignore the test of weakness. It is often the final hurdle before the profit is realized. If you survive the shakeout, your conviction is rewarded. Price shows you the pattern, but volume tells you its power source. Volume is the energy signature of the move. It is the blood flow, the undeniable proof of participation. A pattern structure, no matter how elegant it appears geometrically, is useless if it is not supported by the participation of large interests. Look at volume during the accumulation phase. It will likely be low and irregular. This confirms the quiet absorption of shares. Dullness often equates to low volume, which is exactly what we expect during this silent preparation. But the moment the pattern confirms, the moment the price breaks the pivot point, the volume must become dramatic. It must increase exponentially. A breakout on low volume is often a lie. It is a feeble attempt to lure you in, perhaps conducted by small operators trying to push the price past an obvious barrier before real selling comes in. High volume is the unmistakable energy signature of conviction. It shows the smart money is executing the pattern. It shows that large forces have decided the time is right, and they are committed to supporting the price above the pivot point. No confirmation is valid without volume. If a stock breaks a major overhead resistance level, a confirmed pivot point, and the tape remains slow, be highly suspicious. The move is not real. It lacks the necessary power. Think of it like launching a ship. Price breaking the pivot is the signal to sail. Volume is the depth of the water and the strength of the engine. If you sail a massive ship on shallow water with a weak engine, you will run aground. Conversely, look for volume during distribution. When the stock is high and consolidating, the smart money is selling. Often, the distribution phase will see extremely high volume, but the price makes little progress. High volume, no advance. This is the sign that large forces are meeting that volume with supply, preventing the rally. Volume validates the pattern. It is the proof that the pattern is being enacted by forces powerful enough to sustain the ensuing movement. Ignore volume at your peril. It is the only honest witness. The market does not enjoy complexity. It is fundamentally lazy. It seeks the easiest route. You must recognize the path of least resistance pattern. Pattern recognition helps you identify which side, the bulls or the bears, is currently exhausted. The market will always travel in the direction where the path is clearest, where the fewest obstacles remain. If a stock has been declining for a long period and the sellers have been hitting the bid relentlessly, eventually the sellers dry up. They run out of stock or run out of nerve. When the supply is exhausted, even small buying pressure can cause the price to fly. The resistance overhead is minimal because all the weak holders who wanted to sell have already done so. The path of least resistance is up. The reverse is true at the top. After a massive run, if the smart money has distributed all their shares, the buyers remaining are the latecomers, the public who are now fully invested. There are no fresh buyers left with capital or conviction. Even a small amount of selling pressure can cause a catastrophic drop because there is no one left willing to buy and support the price. The path of least resistance is down. Your job is not to fight the market. Your job is not to wish the market into a new direction. Your job is to identify the most efficient direction the pattern is telling you. Where is the greatest vacuum? Where is the greatest congestion? A solid accumulation pattern indicates the supply has been absorbed, clearing the path above. A solid distribution pattern indicates the demand has been satiated, clearing the path below. Do not confuse the market's current path with what you believe it should be doing. The pattern tells you where the market is easiest to push. Follow that line. It is always the most profitable route. The pattern is always objective on the tape. It is a series of cold, hard facts laid out in price and time. The greatest failure in pattern recognition is the trader who sees the pattern clearly, but allows mental interference to overwrite the visual evidence. The moment you let emotion, ego, or outside opinions override the objective evidence of the pattern, you transition from professional speculator to wishful gambler. Perhaps you bought a stock and the accumulation pattern has failed. The price broke below the low of the consolidation range. The volume signature was wrong. The test failed. The pattern is officially broken. But your ego says, I cannot be wrong. This stock must rally. The news is too good. This is mental interference. This is suicide. I learned early that the market is never wrong. Your opinion, however well researched, is always suspect. The tape is the ultimate authority. If the established pattern is violated, if the market breaks the pivot point it was supposed to hold or collapses back into the range it was supposed to leave, you must accept the pattern has failed. Instantly. You must sever your emotional attachment to the expected outcome. Your hope, your expectation, the persuasive chatter of the pool operators, none of it matters. Only the price action matters. Only the pattern. When the pattern breaks, the trade is dead. It must be liquidated immediately, regardless of the loss you incur. The loss will be small if you act quickly. It will be catastrophic if you wait for the pattern to somehow repair itself. The true speculator does not trade based on internal conviction. He trades based on external confirmation. Never allow the noise in your head to drown out the clear signal coming from the ticker. The pattern is objective. Your mind is prone to subjective bias. Trust the tape. Distrust your desire. Never look only at the 5-minute chart. This is a crucial mistake of the impatient modern trader.
You must understand the scale of the pattern. You must grasp the grand view.
A pattern observed on the daily or weekly chart holds immensely more significance than any intraday fluctuation. The major patterns are the tides. The minor patterns are merely the waves that ride upon that tide. If the daily chart shows a massive distribution pattern, a multi-month top built carefully by the large interests, then any buying pattern that appears on your hourly chart is suspect. It is merely a counter-trend rally, a temporary wave against a powerful downward tide. You cannot make serious money fighting the tide. You can only profit by identifying the major pattern and then using the smaller patterns to fine-tune your entry. The smaller patterns are merely the execution stages of the larger dominant patterns. If the weekly chart confirms a clear accumulation phase, you then look to the daily chart for the perfect pivot point entry, and perhaps the hourly chart for the precise timing of the volume surge. But the overall direction, the risk management, the conviction behind the trade must be dictated by the largest possible view you can attain. The smaller patterns are deceptive. They invite overtrading and they encourage anxiety. They are noise if they are not interpreted within the context of the grand design. I spent years charting the market's behavior across months, noting the broad sweep of the market forces. This discipline taught me that minor setbacks do not invalidate major preparations. A major pattern gives you patience. You know the tide is coming in, so you can withstand the minor waves that might pull the water back temporarily. If you only see the waves, you will panic every time the water recedes. Always identify the primary pattern first. Trade in harmony with the grand view. Everything else is secondary. Seeing the pattern is only half the battle. This is where intellect stops and character begins. The final principle is the absolute discipline of execution. All the insight, all the charting, all the meticulous confirmation of volume and pivot points amounts to nothing if you cannot act when the signal is given. Hesitation is ruinous. Once the pattern confirms via the pivot point and is supported by the energy signature of conviction volume, you must act immediately. The market does not wait for you to summon your courage. When the door opens, you walk through. You do not stand there deliberating about the quality of the wood. Many traders develop the intellectual capacity to see the pattern perfectly, but they lack the nervous system to pull the trigger. They suffer from the fear of being right, the fear that if they commit, they might still be wrong, and then they will have proven themselves fools. This is the psychological barrier that separates the winners from the losers. If you have done your work, if you have identified the accumulation, waited for the pivotal confirmation, observed the high volume and survived the test of weakness, the probability is overwhelmingly in your favor. At that point, your entry must be swift and decisive. No second thoughts, no checking the headlines. The market has given its signal. Obey it. This discipline extends to your exit. If the pattern fails, if the market violates a stop loss that protected the integrity of the pattern, your exit must be equally swift and unquestioning. The market pays those who see the pattern clearly and execute it without doubt. It does not pay the doubters. It does not reward the hesitating man who needs perfect certainty. The certainty is already provided by the pattern itself. Your job is simply to administer the trade. Pattern recognition is an objective science. Execution is an act of will. You must master both to achieve lasting success. You must have the patience of a sniper waiting for his mark, and the immediate ruthless decisiveness of a soldier entering a breach. No time for philosophy. Only time for action. The market speaks in a language of repeating cycles. It is a clear language, a brutal language, and one you absolutely can learn. But you can only learn it if you strip away your complexity and your arrogance. Stop thinking you need an equation that outsmarts the exchange. Stop believing you possess some unique insight the rest of the world has missed. The patterns are always there. They are not hidden by some complex algorithm only accessible to the privileged few. They are obscured by your lack of patience. They are hidden by your inability to trust objective observation over your subjective wish for excitement. Stop searching for secrets. The secret is the pattern. The pattern is human nature repeating itself. Start observing the brutal, simple truth of repetition. Respect the time element. Demand volume confirmation. Wait for the pivot point. Master the pattern and you master the market. You will stop fighting the flow and begin riding the tide. That is the only way to profit consistently from the great game of speculation.